We keep seeing doom and gloom videos about the stock market in 2026. We're told the AI bubble is about to burst, that the current market looks exactly like 2000, and we're watching wars and geopolitical tensions unfold across the globe. And certainly, these concerns have shown up in a couple of pretty notable dips this year. But here's what I find interesting. If all these risks are real, and many of them probably are, then why does the market keep showing so much strength?
And right now, the Schiller PE ratio is sitting at 42, a level we haven't seen since the peak of the dot-com bubble.
And I think this question becomes even more interesting when we look at markets through the lens of chaos and complexity theory. On this channel, we've talked before about how markets aren't simple cause and effect machines. Markets can stay much higher than people think they should. Equally, they can crash with surprisingly little warning. What's often more useful than predicting individual events is understanding the environment that the system is operating in, understanding the rules of the game. And I think those rules may have changed. So rather than trying to predict whether the market crashes next month, let's ask a deeper question. Are we even playing the same game investors were playing 30 years ago? The S&P 500 certainly took a big shock this year, at one stage falling nearly 10%. That sounds dramatic, but in the context of historical market corrections, it's really not all that unusual. As Benoit Mandelbrot argued, large market movements are much more common than traditional financial theory tends to assume. And if we zoom out over the last year and a half, this wasn't even the steepest decline in recent times. Really, what we're looking at here is more like a small pimple on a much larger trend. It's certainly nothing like 2008. And if we zoom out even further, say 30 years, using a logarithmic chart, today's movements start to look even less dramatic. Now this is important because on a logarithmic chart, steady percentage growth appears as a straight line. So if markets are compounding steadily over long periods, the chart should look relatively linear. And perhaps surprisingly, the market still appears broadly on track, which creates a strange situation. Despite all the warnings and all the headlines, the market itself doesn't yet look broken. So if everything is supposedly so dangerous, why isn't the market behaving like it? One explanation is that investors believe we're still in the early stages of an AI-driven productivity boom. AI increasingly just isn't being discussed as just another technology. Many people are treating it more like the internet revolution itself, a structural change that could reshape productivity and future earnings. Markets are, after all, forward-looking. They're constantly trying to price in tomorrow rather than today. And at the same time, the broader US economy has held up much better than many people expected. That's partly because the US economy is more insulated from certain global shocks than in previous decades. Take oil, for example. Events in the Strait of Hormuz can clearly affect global energy prices, but the US now produces more oil than it consumes. That doesn't make it immune to disruptions, but it does change the sensitivity of the system. And there's also something psychological happening. Markets often move more on expectations and narratives. Confidence itself becomes part of the system. And this is where complexity theory starts becoming useful, because complex systems don't simply respond to events, they respond to the rules. This is where things get interesting, because investors often assume markets behave according to fixed laws, but complexity theory suggests systems evolve. And over the last few decades, investors have become used to a fairly particular environment. Low inflation, steady growth, central banks stepping in during crises, markets gradually drifting upwards with occasional setbacks. Over time, these stop feeling like conditions and start feeling like permanent features. But what if they aren't? What if those were simply the rules of one particular era? Because history shows that when environments change, markets can behave very differently. The Great Depression looked very different. The 1970s looked very different. 2008 looked very different. The point isn't that history repeats. The point is that stability itself depends on certain rules being maintained. So what might be changing? I think there are three interesting possibilities. First, indexed investing. More and more money now flows automatically into broad market indices, regardless of individual company fundamentals. Buying an index increasingly behaves almost like a default store of value. And because pension funds, retirement systems, and passive investment flows keep adding money regularly, the market develops a kind of self-reinforcing behavior. Every payday, more money enters the system. That changes market dynamics. Second, debt and policy pressures. US debt levels continue rising, and eventually high debt places pressure on interest rates and economic growth. There's also increasing pressure surrounding central bank independence. If central banks become less independent, one of the key stabilizing mechanisms in the system becomes less reliable. Third, speculation. AI narratives, cryptocurrencies, and newer forms of investing may be introducing stronger speculative behavior. Crypto especially has already shown extreme boom and bust dynamics. Even if it's still relatively small, it reflects a broader increase in speculative intensity. None of these necessarily break markets, but they remove some of the shock absorbers that used to be there. Now, if we start looking for warning signs, valuations become interesting, because while prices themselves don't necessarily look extreme, valuation tells a slightly different story. Take this Shiller price-earnings ratio. At around 42, we're in territory really only seen around the lead-up to the dot-com bubble. Even compared with events like 1929, today's levels stand out, which raises an uncomfortable question. Are markets genuinely operating under a new structure? I think complexity theory pushes us toward humility here. We simply don't know the answer. Markets could continue doing what they've usually done, long-term growth interrupted by occasional corrections. History suggests that's probably still the most likely outcome.
And I'm not trying to give you any specific advice here.
But we could also see something different. Longer periods of drift, deeper corrections, and more boom and bust behavior. For passive investors, maybe that simply means more of the same. Buy, hold, and keep buying. For active investors, market volatility can create opportunities. But the problem is those opportunities always look easier in hindsight. You never know where the bottom is. You never know how long declines will last. And it could be years. So I think the key point isn't predicting a crash. It's recognizing that markets are complex systems, and complex systems can quietly change their behaviors when the rules underneath begin to shift. And right now, I think it's at least worth asking whether that's what we're starting to see.